Meme stocks are back with AMC up 400% in a week. All eyes will be on CPI this Thursday to see if inflation comes in hot. And can the sleepy dollar stage a bounce, which takes the steam out of the hot commodity sector? All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is June the 8th, and let's talk about markets. What's been going on? So major stock indices remained relatively range-bound to slightly higher over the last week. VIX still remaining under pressure, along with cross-asset vol actually also moving down. So if you look at where FX is, you look at what interest rate vols are doing, it's all kind of trending down basically as we go into that sort of summer lull period. Yeah. Let me share my screen of the S&P. All right, so we can see the S&P. So over the last sort of week, kind of stayed in that range, topped out around 42.30, then hit those low area of 41.60, and just kind of stayed in that range. Had that kind of rally towards the end of the week after the non-farms number came in. I know that non-farms number was kind of a Goldilocks number. It was kind of strong enough to show there was some job improvements, but it was slightly below expectations to show that there's no rush for the Fed to taper, basically. So that's kind of how the market took that number. So you've had S&P realize kind of stay around the 7 level. So, single digits, which kind of help the VIX stay heavy. So we bring up the VIX chart. VIX staying very heavy, kind of pop briefly to 19. You can see every time it's popping, the highs that the VIX is managing are lower and lower highs, right? So you had back in May, we got as high as 29, we popped again to 25, and now we only managed to get to 19 and we didn't even break 20 basically. And it just gets sold back down pretty quickly. And like I said, with realized vols hanging around that 7 level, I mean, the future looks a bit bleak for the VIX right now. Yeah, if we kind of stay there. Now, the one glimmer of hope maybe for the VIX is we've got the CPI coming out this week. So if we're going to get any fireworks in the market, then maybe we're going to get it out of the CPI, which is on Wednesday. Okay. But anyway, talking a bit more about what happened with non-farms. Well, obviously you had a pretty tepid number out of non-farms, which should have been expected, right? Because it's the same playbook as what happened the month before, where we had a big miss on non-farms. And you could explain away a lot of that miss by unemployment benefits decentivizing people to work. So that didn't magically change from one month to the next, right? That's still there. So you should have really expected that number. You shouldn't have expected that number to be a blowout number. Now, maybe next month we're going to see an improvement because you have had a load of states kind of come and freeze those unemployment benefits and basically not make them accessible to people, right? So they are trying to force people back into the workforce, and we will see over coming months whether they succeed in that. Yeah. But in terms of the bond market reaction, you had a rally, i.e. a drop in yields into the end of the week, down back to that mid 150 level. And that has been the bottom of the range, right, on yields. Where are we? If I bring up, this is probably the best one to keep an eye on. So we've had this range sort of in that 155 to 170 area. And actually, as we speak, we're trying to take that out to the downside. So yields look like they're headed lower at the minute. That's as low as we've seen for a while. So let's see if it breaks below 150 in a meaningful way, then that's quite an interesting change. We haven't really seen yields that low. That could fuel a bit of a rally in the tech sector. So something to keep an eye on. Yeah. But also you've had a bit of bearish bond positioning. So I think a bit of this move lower in yields is a flush out of people who've been trying to be short bonds, thinking the inflation story is real, thinking that's the way yields are kind of ultimately headed, and they're just getting taken out of that and they're getting squeezed out of that position, basically, right? So what else has been going on outside of that kind of yields lower story? I mean, if we look at NASDAQ, it has recovered a bit of ground. So NASDAQ not quite back to its highs, unlike the S&P, obviously, which is making new highs slowly. But NASDAQ's still got about 2% to go before it can get back to its highs. But if this yield breakdown that's happening as we speak continues, then no reason why the NASDAQ isn't back through 14,000. That seems to be where it feels like it's heading. Yeah, in that sort of environment with yields remaining weak. Now, meme stocks. Big story of last week was what the meme stocks were doing. So you obviously had AMC in the limelight. So AMC managed to rally about 400% in a matter of a week, which is pretty crazy. Obviously the Wall Street bets crowd getting on that trade again. We bring up AMC, have a look at it. So there you go. From about 26th of May to around the 2nd of June, it did 400%, right? Going from a level of around $14 to as high as $75, roughly. Now, as a result, obviously, volatility has just completely exploded, right? So if we bring up some kind of screenshots that I've taken out of my vol analytics. So here, you've got various maturities options, implied vols. This is from the Interactive Brokers Vol Analytics Lab. And you can see, short dated vol went from about 100. All the vols were kind of hanging around. If you look at what was going on in sort of early May, all of the different expiries in AMC were running at around 100, 120 vol, which is still pretty high, but that's where they were. Yeah. But AMC was easily doing 5 or 10% a day. So that's kind of in line. Since that explosion higher, you see what vol did, right? So you got short end, like weekly options got as high as 650 vol, 1 month stuff going into the 500 region, and even the long end stuff, like 6 month to a year stuff going into like 300, 250 area. Okay. So this is an absolute explosion in volatility. And for a vol trader, this kind of, grabs your attention. And the reason it does that is because it provides great opportunities to put on trades, right? So when you see explosions in volatility that are clearly not sustainable like this, and we saw the same thing happen in GameStop earlier in the year, it presents fairly nice risk reward opportunities to kind of play some vol selling strategies that you do in a smart, contained way, but it kind of provides you some alpha opportunities basically to try and kind of capitalize on this crazy volatility that the market seems to have gone into, this regime. So the type of trades that I've been doing, I've been selling June put spreads. So with the stock at around $50, I was selling like the 25-20 put spreads expiring in a couple of weeks. Pretty decent risk reward there, collecting, $1.50 to $2. Most you can lose is like $3, $3.50. So risk reward pretty good, and that thing's decaying pretty fast. So you could get your premium pretty quickly, right? And if the market rips higher again and we go through the local highs at 70, then that put spread is just going to evaporate and be worth nothing, and you can buy it back ahead of time if you want to. So that's one way of doing it. Some people are advocates of selling longer dated puts, so not put spreads, but just outright puts. So maybe the December puts in the 10 strike region, because given the move up in the stock, AMC has obviously managed to raise a load of capital because people are paying the wrong price for the stock. So they're happy to sell some stock, issue some stock, raise the capital, improve their balance sheet, and shore up the company so that, the CEO has been savvy to that and managed to do that. But that effectively means that the downside in the stock is basically sort of not as bad as it might have been before. So there's probably a good argument to say the stock's going to struggle to go back below 10. So to bang out a load of December 10 puts and receive a couple of dollars for them doesn't look like the worst trade in the world, right? So selling out some of those long dated puts just naked, knowing that the stock, worst that can happen is it goes to zero, but the probability of it even going back to 5 or 6 has probably gone down quite a lot, right? So that's another trade people are doing. And then one final trade that I quite like, that I did a bit of the other day, was I sold some June calls, wait for it, but I bought some July calls against them. Yeah. So again, doing a bit of a term structure trade, selling out the stuff in the 500 vol area and buying back something in the 350 area and trying to capture some volatility arb there in a relatively safe manner, not in crazy size, but these are the type of vol trades that if you kind of understand what you're doing and you know how to kind of not run too big risk, but see where the opportunity in the vol surface is. And these are the kind of trades that you can spot and do, right? So that's what I was doing, right? Some June, July call calendars, basically. Right. Else, so this week's going to be all about the CPI, right? CPI is the main event this week. That's what caused the rumble last month, and we had a blowout print in April. All eyes are going to be on this print, right? So if we look at what kind of matters here, this is kind of what matters. So you've got the main driver of that big CPI was used car prices, okay? And used car prices have continued to explode. So, chip shortages are being blamed for this, but used car prices are absolutely flying, and they're going to be a major component of that CPI. But you've also got shelter, so rent and shelter. And basically, that is like the secondary component that's important. So if you look at the breakdown here, main drivers of the core inflation, got shelter, used vehicles, and transportation services. So I'd say shelter is probably going to be the most important one to keep an eye on, because everyone's expecting used cars to be on the moon. And so they might look past that as a transitory effect. But if we're starting to see shelter prices rising as well, that might be looked at more as in less transitory, and that might spook the market a bit more. So keep an eye on the shelter when we see that CPI print, if it comes out ahead of expectations, basically. All right. That's really the main message there on CPI, I would say. So I'd say that's the thing that could maybe rattle markets this week. So keep an eye on that. And the type of stocks, obviously, that are not going to like that are going to be the growth stocks, like the ARK ETF type names. They're the ones that get particularly kind of hurt by that inflation story. Let's kind of keep an eye out there. Let me go back to my screen. What else? So what about if we keep going higher? So it looks like on the kind of index level, 4250 is being kind of touted as the main resistance area that we should kind of see, because there's quite a lot of gamma still out there, and you can gauge that from the fact that vol's been getting destroyed, right? So when vol gets destroyed, it means dealers are getting hit in gamma. And the kind of regions where they're getting hit in gamma are the 4250, 4275 area. So in theory, you should get a bit of resistance in the market up there. That's going to make it quite hard for the market to break those levels. What can maybe keep the market going higher? I would say if vols remain low, as they have been, then systematic buying flows continue to come. So there's some estimates from the likes of GS that we might see 40 to 70 billion over the next month of more inflows coming from the systematic type funds that are kind of dependent. What their behavior is dependent on what volatility is doing, and if vol stays low, then they keep coming. You've also got corporate buybacks. Obviously, the tech sector, that's big. You also got banks doing corporate buybacks now as well, ongoing, and they're going to go into a blackout period around mid-June, early July. So that those buying flows will still be there until maybe June expiry in a couple of weeks. So that might continue to see a bit of a grind up environment where the market is well supported and kind of manages to climb the wall of worry. Not that it feels like there's much worry out there right now. But it might be that, say we get a high CPI print that wobbles the market, maybe we then rally straight back because we've got those underlying sort of buying going on from the likes of the corporate buybacks, basically, right? So that might be a reason why any sell-off this week on a high CPI print might be just bought quite ferociously, quite quickly. Yeah. So it's hard to see really what's going to rock these markets in the immediate term. I mean, investors are long, so there's a few indications of investors being long. You had a Bank of America private client survey showing that equity holdings, private client equity holdings are looking like they're at 20-year highs, basically, in terms of percentage of AUM allocation to equities. But then, can you really blame them, right? We are in an environment where equity seems to be the obvious place to allocate, given what's going on. But then, whilst investors might be long the market, that doesn't mean it's complacent, right? You look at things like the skew index. Let me share the skew index if I've got it up here. So skew index, like a CBOE index that has been around a while. And, whilst there might be some kind of, technicalities that aren't quite amazing in the way it's calculated, it still should give you a gauge of like the relative expensiveness of downside puts versus upside calls. And the higher it is, the more protection that has been bought, basically. Let's think about it like that, right? So you look at that, in terms of the range it's been over the last 6 months, it's kind of not far off the top of that range, right? So that would kind of suggest that skew is relatively high, which means investors aren't complacent. So that investors might be long, but they are also likely quite well hedged, right? Which means that there's no need for a major panic should the market go into a correction and sell off. Okay, that's kind of the kind of thing to kind of glean from that, I would say. And that's kind of the setup in kind of US equities. I mean, okay. What else? So then we can go on to talking about FX. So what's been happening in FX? Kind of the same thing that's been happening in FX for the last few weeks. It's pretty sleepy. You've had the dollar, forming a bit of a base at least, just above this long-term support zone, 88, 89 on the DXY. So you look at what momentum's been doing in the dollar, slowly been sort of working its way higher, and we're hanging around at that bottom end of the range, right? So it tried to pop to around 90 and a half, kind of didn't manage to stay there, but it's hanging around 90. So all of the kind of downside momentum seems to have been taken out of this dollar move now, right? So does that suggest maybe the dollar's setting up for a bounce? I think it probably does over the summer. It might have one last little push down towards that zone so it can actually touch that zone. But I'm starting to favor some sort of summer bounce in the dollar. So that's what I'm kind of waiting and watching for, basically, right? And in terms of the dollar, you could see positioning on the dollar has been getting kind of more short, right? So there you see non-commercial asset manager and leverage funds, non-commercials, asset managers have extended their short positioning in the dollar. And despite more shorts being put on the dollar's kind of hanging in there and not collapsing, right? So that to me signals if positioning's got short and it can't sell off anymore, maybe that positioning needs to get squeezed out, basically, right? So that's something, that would kind of support that potential scenario, I would say. So that's kind of what I'm thinking on the dollar. And then the only other currency really that's interesting is maybe the pound, where it just hasn't managed to break this 142 area. There's been some kind of protests in Ireland around this sort of North Irish border and customs issues around there. So that's kind of maybe weighed a little bit on the pound, that we might get some more sort of negative headlines and news around Brexit and how Brexit's going, basically. So that's kind of being used as a potential excuse as to why the pound hasn't managed to break yet. But I do think at some point it probably does break that 142.5 area and has its next sort of leg higher, basically, towards that 145 area, right? So, I mean, that's consistent with the dollar actually breaking down. So I think the dollar probably has some sort of bounce this summer, maybe towards 91, 92 area. And then ultimately the dollar's going to break those supports at some point. And then that's where the pound maybe has its leg higher later on in the year. But I'm starting to favor a dollar bounce over the coming month or two, basically. Yeah. And if we get that dollar bounce, then, what does that mean for commodities? Well, obviously that could take some of the wind out of commodities, right? So if we have a look at, what the commodities have been doing, this chart I've just put a few of the favorite commodities on here, or the interesting ones. We've got oil. What's been happening over the last sort of month on oil, copper, and lumber. So oil's been continuing to charge on, yeah, as OPEC seem to have kind of managed to manipulate prices higher and do what they do. But then copper and lumber, which were very much driving the commodity rally, they've been in consolidation mode. Okay, so they've been, copper's down over the last month, let's say, or from its local highs, probably about 5%, and lumber's down 20 odd percent. So it's quite interesting to see that those are relatively weak. And if you look at maybe what the reasoning and what the drivers are behind that, well, a big one is this. So Chinese imports. So Chinese imports have slowed massively, right? So crude oil imports are at a 5-month low, coal 3-month low and down 25% year on year. Iron ore's at a 12-month low, and copper ore, well, overall imports down, but okay, I don't know what that's trying to say there. But the copper, not so much. Copper, there's still a bit of demand for, but a lot of these commodities that China are importing, those numbers are dropping basically, right? So you shouldn't be surprised to see a bit of consolidation. And you know that China have been going after commodity speculation as well, trying to clamp down on that. So a few slightly negative headlines around the commodity story. Doesn't mean that commodity story is over, just means that it's going through a consolidation phase, which markets do. And it had a huge run up. So we shouldn't be overly surprised to see that happening. Yeah. We bring up some of the charts. So oil, obviously, I was saying, if it broke that 68 level, I would try a little cheeky buy. So I have got myself long some oil. So far, hasn't done too much. But if we bring up copper, yeah, you can see it's in that consolidation phase, hanging around just above the sort of 50-day moving average, which it seems to like bouncing off. So it hasn't taken that out yet. I mean, I think, I bought some tactical copper on that first pullback. I actually already got rid of it. I'm ready to kind of reload it a little bit more at 435 if we can get there. So I'm just kind of trading around that sort of consolidation at the moment. Still love copper long term, so I still have it in my long-term portfolio. But on the tactical side, I was thinking it was probably going to roll over, and it seems to have done that to some extent. And then, the ags have actually been quite strong. I thought the ags were going to have a bit more of a violent pullback. So they had a pullback, they've had a violent bounce. Is that pullback over? I'd be surprised if it was, but you never know with these crazy commodities. So we'll see if it takes out the highs, it might go again. But corn, very violent bounce. I wouldn't be getting involved with this until we see another wave down to complete the correction, and then into a sort of key sort of support area. If we get another move lower, then I'd look to maybe get on board the corn or the grains sort of train. Yeah. That's kind of how I'm thinking about like those major commodities. I mean, you've also had some data showing that speculators have taken positioning down a bit as well. So I'll share that in the market report, that graphic, but kind of shows that there has been some sort of position reduction going on in the speculative side on commodities as well. Kind of helps with that pullback and explain that pullback. And then the other main thing to think about is precious metals. So, gold gave us a nice little opportunity, gold, last week, pulling back down to around 1860-ish, slightly below. So for those who've been kind of watching this level for a while, once we broke above it, the idea was that if we retest it, then that should act as some sort of support. And it also kind of coincides quite closely with the 200-day moving average around 1840. So that 1840 to 1860 zone should be acting as some kind of support for gold if the new up leg has begun. So I did buy the dip in that gold pullback. I put a stop at sort of 1835 to say, well, if it can't hold that support, then maybe that was a false breakout. So yeah, I think buying dips in gold around 1860 with a 1835 stop makes sense here, basically. Yeah, so I quite like that on the gold front. And the longer term sort of view on gold, the bullish sort of narrative on gold is that you think the Fed will do everything they can to keep rates low, even in the face of higher inflation, right? And that means that real yields will remain negative and go more negative over time, and that will be very, very bullish for gold over the long term. But that's the longer term narrative, which I can kind of sympathize with. And then the other thing I noticed was silver. Silver just seems to be a bit sleepy, right? It seems a bit more range bound. Isn't really rallying quite as hard as gold or keeping pace with gold, but it's not really selling off either. So I had a look at kind of some of the volatility metrics on silver, see if there was maybe a trade there. And I came to the conclusion that just sort of underwriting, i.e. selling puts on silver isn't a bad trade, right? So if you look here, this shows you implied vol on silver, shows you 10-day and 30-day realized at like 23, implies at like 30. So for me, just kind of not doing this in crazy size, but doing this in a size where you'd be comfortable actually buying some silver at a discount price to where it is now, that's called underwriting. So if you look at where silver is, let me bring up the chart. So given that you can see the implied vol is quite a bit higher than what it's realizing, that's telling you that vol's probably a good sale in silver. And then you can use that knowledge to say, well, okay, silver, you know, where am I happy to get long? If I'm happy to get long at maybe 26.5 or slightly below there, given, you know, these sort of moving averages might act as support and that kind of uptrend is intact, maybe that's where you're happy to buy it. So then selling the 26.5 puts to take in some premium out of this, what looks like quite expensive volatility. And then should you go down there, you're happy to take delivery of that silver exposure. That might be a nice way to kind of capture some income, basically, or capture some premium. So that's kind of what I've started to do. Relatively short dated options, you know, 3-week type stuff. When I sell options, I generally like to sell stuff that's quite short dated, so I earn my money quickly. When I buy options, I tend to try and buy slightly longer dated stuff so it doesn't decay too fast. So I've just been dipping my toes in and starting to sell like some of these 26.5 puts in silver instead of buying futures or buying calls, basically, right? So I think gold vol is relatively cheaper. So if you're going to buy volatility in precious, you probably buy calls on gold, probably buy longer dated calls on gold, maybe March next year type stuff. You don't know how long it's going to take for the real gold rally to kick in. But if you want to sell vol, in the meantime, on something that looks quite expensive, you sell puts on silver if you're kind of thinking precious metals stay relatively well supported. Yeah. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. I'd also encourage you to sign up for a free trial to our live and interactive Macro Insight Zoom call. As part of our trading community, as well as the call, you'll also get access to our Telegram chat and our weekly market reports. To find out more, you can also connect with us on the socials. All the links are at our website, www.options-insight.com. Thanks.